this is Dr. T. Varalakshmi discussing you about the activity ratios as a part of business economics and financial analysis. In the previous videos, already we have discussed about what is the ratio analysis and liquidity ratios. And one more ratio under this ratio analysis is the activity ratio. The main activity which is performing by the organization is its production only, because by selling of that product only an organization has to get that one. So here the activity involves right from purchasing activity to work in progress as well as to the sales. In this one, many activities are involved. So purchases means, so they have the two elements. One is the cash purchases and credit purchases. If any person is credit purchases means the person is giving the goods to the organization and the organization will give the bills payables. Bills will be raised by the organization to that person, which means the organization has to pay and benefit is received from this particular seller, then that person will be called as creditor to the organization. So the organization has to pay the bills to the creditors. Then work in progress, that is again this once if they have purchased, then that will be treated as an inventory to the organization. That inventory which is at store, or if that goods is transferred to the work in progress, then at that time goods, and once if they have finished that goods, then if they are going to the sales, at that time up to the selling of that product, right from raw material to the finished good, all the stages of that good will be called as that inventory. And if the sales has done, again the two possibilities of the sales, cash sales and credit sales. So which means the person to whom they have sold is not repaid to the organization. So at that time, the organizations will receive the bills from that person, that is called as bills receivables, which means the organization has given benefits to the organization and he received the benefit from the organization. So that's why that person will be called as the debtor to the organization. So from this debtors, they have to receive the bills, and to the creditors, they have to pay the bills. In between that one, they need to maintain this inventory. For all these activities, how efficient it is going to be evaluating with the help of this ratio analysis. And third two, the organization, if we assume, if it receives within 3 months and it has the capability of payability within 3.5 months, means up to the 3.5, that is up to 15 days, the organization has the time period to repay, and that too, within 15 days for their operations, they can use that money. So that means the organization is very efficient. If they have to repay within 2 months and they can receive it within 3 months, means it is not that much of efficiency by the organization. So like this, we can do that kind of the analysis for their operational efficiencies in this with the help of this activity ratio. No doubt at all, for this activity ratio also, mostly the analyst must have the knowledge from the trading account, profit and loss account and balance sheets of the organization. So the purpose of this computing the activity ratios is to manage this management's ability in efficiency utilization of this company assets, because it is going to be measuring the each and every productional activity involved in the organizations, and also in handling of the long-term assets are also how efficient they are going to be evaluating here. So if we see this, these activity ratios will also called as the efficiency ratios. So because their efficiency will leads to the best productional elements. That's why these are all categorized into accounting receivables turnover or the ratio, account receivables ratio, inventory ratio, account payables ratio, working capital turnover ratio, and fixed assets turnover ratio, and total assets turnover ratio. So these methods are going to be, these are all the subcategories of the activity ratios. So we'll see one and each and every ratios of these activity ratios. If, in combinedly, if we see this activity or the efficiency ratios, inventory turnover ratio, which means how much of cost they have incurred for the goods divided by the total inventory. For example, if they have purchased 10,000 worth of the goods, so if the 20,000 worth of the goods are all with the organization, which means the cost which is incurred on that one and how much worth of the inventory is there, the ratio between that one. If the cost is less and the more inventory is with the organization, then they can say that their efficiency is good. Even in this house are also, for example, so your mother has purchased 10,000 worth of the good for 8,000. The cost she has incurred is 8,000, but the worth of that good she has purchased is 10,000, which means she is the best inventory manager. So same thing in the organization also, how much cost of the goods sold, what they have, and what is the inventory left with the organization can. That is inventory turnover ratio. And for the total revenue, what are the total assets in your family also? If your father is earning 50,000 and with this 50,000 every year he is going to be paying EMI, and with that revenue which he has generated, how much worth of the assets he has purchased, if that is going to be evaluating, then that will be called as assets turnover ratio. In the assets, both current assets and fixed assets will be takes into the consideration, but only fixed assets like land, building, that only takes into the consideration. That will be called as fixed assets turnover ratio. We can say that it is a subcategory of the assets turnover ratio also. And the receivables turnover ratio, so generally the bills has to receive out of their credit sales, that is from the debtors, or we can use it the term of the credit sales or the debtors are also. And account receivables, out of that one, how much of credit sales has done and how much of account receivables are all there. Based on that we can calculate that one. And account payables to the creditor, to the creditors, how much of amount they have to pay, that is total credit purchases. Here is also the total credit purchases divided by average accounting payables, they have to take into the consideration. So some other terminologies like another, if one data is not available with the using of then another data is also using under the activity ratios. That's why this efficiency ratios for this one, inventory turnover ratio, anyhow cost of goods sold, instead of the normal inventory, average inventory also they can take into the consideration. That is opening stock plus closing stock divided by 2. And account receivables turnover ratio, that is net credit sales by account average account receivables are also they can take, instead of account receivables average value also we can take. Same as with account payables, assets turnover ratio and days sales in the inventory. So here if we see these two, these are all going to be interchanged. Inventory turnover ratio, what is the total benefit they gain by the organization for their inventory, or day-to-day sales, what are the goods inventory they are taking into the consideration, that can be done in this one. So like this, average value they can take into the consideration, or the entire total value also they can take into the consideration for this evaluation of the activity ratios. The assets turnover ratio, or also called as in this assets turnover ratio, inventory turnover ratio is one of the most important one to determine the number of times which they have purchased for their productional activities and how well they are maintaining their goods at the storage levels. For example, if they have purchased many times, but if they are work in progress, at the work in progress, if the wastages has done, that is easily identifying with the help of this inventory turnover ratio. So here it gives the knowledge of why we have to improve that ratio. So because the lower ratio indicates the company doesn't more the stock is required. If the inventory turnover ratio is less, then the company can know that their inventory is not sufficient for the organization. At that time, they can improve the stock levels of the organization. And That too, the lower level of the ratio will signs a bad sales or the surplus inventory. So they have the goods with them, but the sales are all less. So that is easily identifies with this inventory turnover ratio. And generally, if a product sales is faster, inventory turnover ratio will be very better, and the high ratio will indicate the high sales of the organization. So that's why to better forecasting of the sales and to reduce the prices of the organized product and better inventory pricing and top selling of the products, better management activities and the stock level and old inventory usage levels, wastage for the reduction of the wastages and all, they we have to use this inventory turnover ratios. Mainly, the inventory turnover ratio is going to be calculating with a formula of cost of the goods sold divided by average inventory. So that is on an average, how much of goods are all purchased during a particular financial time period is going to be evaluating with the help of this inventory turnover ratios. Here, the cost of the goods sold formula is beginning inventory. Let us say beginning opening stock of that business is 9,000 worth of the goods were there with this organization, and later they have added the purchase of 7,700 purchases this year, and by the end of the year 9,200 worth of the goods are just left out with the organization. So which means for the goods which they have sold, only they have spent 7,500 worth of the goods cost goods or only they have sold. So that is a formula for cost of the goods sold. Generally, here also, for example, we have already in our house 10,000 worth of the goods are all there. Rice is there for conduction of the any function. Assume that we have the 10,000 worth of the rice, and we are expecting 20,000 worth of the rice is required. That's why we have added some more 5,000 worth of the rice. Total 10,000 opening of our house plus 5,000, that is 15,000 worth of the rice is there. But due to the less sales or the less number of the people coming to our house, only 8,000 worth of the goods are only used, and remaining 7,000 worth of the rice is left with their family. Then which means how much cost worth of the goods we have consumed. 8,000 worth of the goods are only we have consumed. Same way, an organization at the beginning level, what are the goods, that is opening stock plus purchases minus ending inventory, that is equals to the cost of the goods sold. That is a formula for that one. For this inventory, again, opening inventory and ending inventory, average we can take into the consideration, or the total inventory also can take into the consideration. Generally, if the opening and closing is there, both are there, it is better to have the average inventory. If it is not there, then any of these one it can take into the consideration. The second sub part of this activity ratio is assets turnover ratio. So that is the total assets, what are the total assets of the organization, and what is the sales that has done by the organization is going to be evaluating. For example, total sales they have done is 10,000. Out of this one, average investment in the assets is 5,000. Then we can say that 1:2 ratio benefits are all there with the organization. So that is to define the value of sales generated by the organization. They will take this assets turnover ratio into the consideration, because it gives this advantage is to give a better view of compared to the sales figure. And there too, a higher figure says that a better management, a lower figure says that a worst management or the inefficient management of this organization. So there are certain disadvantages too are all there, like it measures only companies earning profits are only, it won't take the efficiency into the consideration, and return on earnings is not going to be evaluating with this one. So out of that sales, what is the average investment of the inventory only taking into the consideration. That's why here the formula is total sales divided by average investment in the assets. Whereas the average investments means assets at the opening balance and assets at the ending, that is opening stock plus closing stock divided by 2. That is the assets turnover ratio. So the assets turnover ratios formula preparation again, total assets turnover ratio, or only if the fixed assets takes into the consideration, it will be called as fixed assets turnover ratio. Only current assets if they take into the consideration, then that will be net working capital turnover ratio. Only the goods sold are taking into the consideration, that is inventory turnover ratio. And if only account receivables takes into the consideration, account receivables turnover ratio. And these are all the respective formulas for this total assets turnover ratio, that is sales revenue divided by the total assets. And for the fixed assets, sales revenue, but total fixed assets are only takes into the consideration. Whereas in the net working capital ratio, sales revenue divided by net working capital will be takes into the consideration. And inventory turnover ratio, sales divided by the inventory for the day-to-day sales, account receivable, sales revenue divided by account receivables, and on an average how much they are going to be receiving can be calculated with the help of 365 days divided by receivables turnover ratio. So these are all the various assets turnover ratios. Here we can say that if that ratio is more than 1, efficiency of the management, if it is equals to 1, it is less efficient, or it is equal, whatever the assets they have, what are the sales are all there, that is equal. And if it is less than 1, inefficient, more assets less sales, that can we can interpret of this assets turnover ratio. This advantages of this assets turnover ratio is easy to compare, easy to calculate, and helps in better decision making regarding the purchasing of the goods and stores management and ledger management. This is a most important one. But disadvantages are all there, because only sales revenue is taking into the consideration, and depends on the historical data it is working, but it won't take the any economic resources, or the total profits consideration is not taking into the consideration. So that's advantages are all there, disadvantages are all there, but assets turnover ratio is gives the knowledge of what are their sales, what are the inventory used by them. That is the main objectivity of this assets turnover ratio. Then in part if we see account payable or the creditors turnover ratio, account payable ratio, or it is also called as accounts has to payable to the creditors only. So then that will be called as creditors turnover ratio. So once if they have done the purchases, cash purchases will be there, credit purchases will be there. So then the credit which has given to the organizations will be called as the creditors. And so for this conversion period, so then they will pay for this one. They later some time period will be taken. That time period will be called as velocity or the speed of the bills payment. Within 365 days, if they pay, then there will be the speed or the velocity is less. 52, or we can denote with the less time period to repay will indicate the more efficiency of the organization. So that the velocity can be estimates in terms of the months or weeks or days. That is average credit period. For this conversion, are they taking more months, or we can say we can measure in terms of the weeks, or we can measure in terms of the days also. Let us say 6 months, 2 weeks, 3 days. So like this we can measure. And a higher credit ratio and short credit period, a higher credit ratio will indicate that within a short span of time they are paying to the bills. And lower credit ratio means they are taking more time to repay the bills. Higher ratios always prefers best credibility of the producer. If we take this one, account payables or the creditors turnover ratios formulas, it can be expressed the number of times as per the creditors turnover ratio, that is credit purchases of the stock divided by average creditors. The average number of days it takes to payment months calculation will be creditors turnover in terms of the days, that is average creditors into, for this same only, into 365 days divided by credit purchases of the stock, or simply 365 divided by creditors turnover ratio they can take into the consideration. So any of these one can be possible. So next thing is, till now we have discussed about this creditors turnover ratio, and the next part is account receivables or the debtors turnover ratio. So if the organization has done the credit sales, then they have to receive the bills from the debtors. That how much frequently they are taking receiving the benefit from the debtor is going to be evaluating, and here the collection period, how frequently they are collecting the debts from the debtors is going to be calculating. The non-performing assets of the organization's possibility more here, and that's why it is better to calculate this account receivables and maintain the high ratio of the better account debtor or debtors turnover ratio by the organization. Here its formula is net credit sales divided by the average debtors, whereas the average collection period is number of days divided by debtors turnover ratio, that is 365 days divided by debtors turnover ratio. So improvement for the debtors turnover ratio, the organization has to define credit policies. So for example, the credit policy of the organization can be allow up to 6 months, but it is not giving that much of benefits, means they can change that credit policies, and they have to improve the collection efficiencies, like any collateral basis or any security amount raising by the people, and offer discounts for early payments. If they pay early, some discounts or the rebates, rewards for the timely payments, and discount of the discourage the late payments, or any implementation of the penalties for that one, reporting of the purchases by analyzing that one, so that they can do for the next time, or to the next seller they should not do like this. So all these are all some of the improvements for the debtors turnover ratio. So that's about the activity ratios and its types for the analysis of financial statements of the organization. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.